Welcome everyone to the Investor Connection, the first ever collaboration between Investopedia and Morningstar. I'm Caleb Silver, the editor-in-chief of Investopedia, and I'd like to welcome everyone who's joining us here in person. We've got folks streaming in now. We've got hundreds of people online who are tuning into this virtually. Welcome. This is an exciting event for us, and I've been looking forward to this for a very, very long time. We're delighted to have you with us this afternoon as we dive into some of the most important issues facing individual investors today. It's a really tricky time. There's a lot going on. So we brought some experts, both from Morningstar and some of our friends here at Investopedia to help sort some of these topics out. So we're going to have some very interesting conversations coming your way. We've always admired Morningstar when we think about brands that we'd like to be associated with and partner with and sort of share the stage with. They're at the top of the list. Like us, they're rooted in investor education. Like us, they believe that a smart investor is a better investor, and so we come from the same place, the same DNA. We try to be educated investors and teach that through our different publications. We have brought, as I said, some of the smartest people we know into this conversation this afternoon. So we're going to have a few panels, and then we're going to have opportunities for Q&A. There'll be mics here in the crowd. Online, we're taking your questions. Don't worry, we'll get to your questions as well. And let's get after it. I'd really like to say a special thanks to the teams at Morningstar and Investopedia for helping put this together. Brian Addison and I dreamed up this idea back in the spring, kind of a bird brain idea, but it actually started to get some momentum, but it wouldn't have happened if we didn't have the support of our teams who actually put this together. So thank you, all of you who are involved in making this happen. And thank you all again for coming. This should be a lot of fun. And don't forget, when this is over, at around 5 o'clock, we're going to be going down to our roof deck for a little reception. So hang in there for that as well. And we are going to dive right into our first conversation. I have the pleasure of hosting it. I'd like to call to the stage Christine Benz, the Director of Personal Finance for Morningstar, John Rekenthaler, the VP of Research for Morningstar, and Anastasia Amoroso, the Chief Investment Strategist for iCapital. We're going to be talking about how to reset your portfolio for success, and that's a conversation we need to have given the year that we've had. So I'm delighted to have them here. Thank you guys for being here. It's a pleasure to see you on the stage and be having this conversation in person. Some of you have been on my podcast before, but to actually meet you and be able to have this in front of friends, online, and in person is a real treat. So I'm going to start with you, Christine, because, and I think everybody would agree here, we haven't seen a market quite like this. I don't know if we've ever seen it where you have this simultaneous decline in both the equity market and the bond market. The bond market is supposed to cushion you at times like this. That's not what's happening now. Any precedents for this and any way to make sense of it just from an individual investor's perspective?
It seems that the closest time period historically is sort of the 70s, where we had rising rates, high inflation that did crimp stock and bond prices simultaneously. But certainly in my lifetime, my guess is in many investors' lifetimes, this is the first time we've seen that. Because historically, in the past few bear markets at least, bonds had a really nice cushioning effect for equity losses. So I do think the fixed income portion of investors' portfolios is what really is worrying them and bugging them right now, because it is the asset that they had been looking to provide a cushioning effect, and it's just not delivering, obviously.
Yeah, Anastasia, we've been living in this TINA world for a long time until recently, and now there is an alternative. In fact, there's a few other alternatives, but for a while there, it was stocks were the only game in town. U.S. growth stocks were the only game in town. A lot of that's changed. You watch a lot of these metrics closely. What are you noticing beyond the fact that there's now a place to get some yield, but you've also watched the movement of money very closely?
Yeah, there's a lot of different alternatives we'll talk about in just a minute. But to pick up on Christine's point, I mean, this is sort of the year we've been all scared of having, and we finally had it, right? I mean, think about the last several years when we were looking at bond yields and everybody was saying they're way too low. When they rise, they're going to rise. Bond prices are going to collapse, and equities are going to reprice down in unison with them. So here it is. We had this year, and maybe this is sort of the clearing event that needed to happen. But as a result of this repricing, Caleb, you're right, there's so many more alternatives to get yield on your portfolio. I mean, coming into the year, if you were sitting on cash, that was paying you zero. That was paying you nothing. If you were investing in high yield, the spreads have compressed so much and the rates were so low, the yield to worst on high yield was 4.5%, maybe 5%. Well, you fast forward to today, and I don't know about you, but I'm excited about looking at CDs right now. I'm excited about like 1 month, 3 month CDs. Like we have not seen rates like this. Well, after the Fed probably hikes, this week, we've not seen rates like this since 2005, 2006. So you can look at cash, you can look at short-term liquid cash alternatives, and you can get some yield. You can look at munis, you could look at U.S. Treasuries yielding you close to 4% for 1 to 3 year paper. That's really exciting. And then you go out on the credit risk spectrum, and I realize you're taking some credit risk, but high yield has repriced to 8.5% yield to worst. So by the way, when yields are above 8%, the old adage says you were supposed to buy that, because once yields fall and spreads compress, that ends up being pretty good returns for high yield investors. So bottom line is there's a silver lining, and a major one is that after this major repricing in bond yields, there's something to do in bonds again.
Yeah. John, is it time for some boring investments? Is it time to be thinking about other things that we haven't really put into the investment mix? A lot of us, especially folks that are not in retirement yet, thinking about those other products. She talked about CDs. I get excited about CDs. We just need to get out a little bit more, I think, you and me. But you're getting a lot of offers in the mail these days. Is it time for some more boring, slower investments?
Well, the thing that one tends to encounter when you have downturns like this is when people are thinking about, hey, maybe it's time to make a change in my portfolio, they tend to look at what's been working well recently. And for example, I had quite a few people writing to me in April, May, June, talking about commodities, commodity funds. Should I have more commodities in my portfolio? And there was, at least in that case, there was certainly an element of bolting the barn door after the animals went out, because I looked it up, and the commodity index is down 15% since the middle of June, which would be rather unpleasant if somebody had gone in there in the middle of June for protection against rising inflation and maybe even sold assets that had already lost money for them, and then bought something that dropped another 15%. Of course, if they stayed in stocks, they'd be down probably since then too, a little bit, but not quite 15, at least not in most stocks. So, I tend to think that the best thing to do in these circumstances is look at what you already have in your portfolio and maybe move toward some of the things that have been beaten up the most, for example, like high yield bonds or at least if you're going outside of your portfolio, you don't have buy high yield bonds that you don't have something that's already been taking some lumps and licks rather than chasing the recent success. That's the danger when you ask that question of like, should people be doing something new? Yeah, but be careful of chasing that which has recently
and
succeeded.
Chasing the herd has not been a great strategy lately, because the herd shifts very quickly these days, and I think everything, the velocity...
It's not a huge herd, but there's been a small movement at least positively in toward commodities, for example.
Right, but the velocity of everything just seems to be increasing over time. The speed at which we go in and out of recessions, or at least the last recession, the speed at which sentiment shifts, all of these things change, but some basic rules still apply. And Christine, I love your pyramid for thinking about how to invest and how to allocate your portfolio. We're going to share that in the notes to this conversation. But you have some very basic things talking about investment, what's safe. You're talking about being tax efficient, your own behavior, trying not to get in the way of yourself, as we say. Talk to us through some of the things that just remain constant no matter what type of market environment we're in.
Sure, and just to describe the pyramid that Caleb referenced, it was the idea of kind of that food pyramid. People who were in school in the 70s probably remember that it had us all eating a whole bunch of carbs. That was the base of the pyramid, that we should spend most of our diet on carbs. Turned out that was all wrong. But the basic idea with this investing pyramid is, if you have a fixed amount of time and resources, you'd want to allocate to the important stuff versus things that do not deliver a good return on your time and your capital. So at the bottom would be having a goal, having a well-articulated goal, having a sense of what that investment goal will require in terms of funds. Managing your own behavior is certainly huge, and we have reams of data on how investors do oftentimes undermine their own investment success by chasing, as John was talking about, chasing what has recently outperformed. looking at asset allocation, making some basic decisions based on your life stage, your proximity to needing your money, about how to apportion your investments from conservative to more aggressive. So those would be some of the key things that should be part of investors' dashboards
Yeah,
today.
so no matter what, you got to keep those in mind. Anastasia, I was kind of astounded recently when I heard that ETF flows have actually been constant and actually been rising this year. And I'm like, well, where's all that going? Well, clearly not into the equity market, not into the growth part of the market.
Yeah.
A lot of that has gone into fixed income. A lot of that has gone into some short-term stuff. But when you look at money flow broadly in the environment that we're in, especially over the last couple of months, what are some of the things that stick out to you?
Yeah, so it's interesting that you bring up the ETF point, and I was actually puzzled to see that the ETF flows have been positive this year, but I think you're right to point out that it depends on what sectors of the market they've been positive into, which, by the way, mutual fund flows have not been positive this year, but investors, by and large, have still been buying the dip in equities. I think things that they have been buying have been the dividend-paying stocks. If you look at an ETF like DVY, for example, it is down 3% on the year. So clearly it's held up well in this inflationary environment and it's garnered some of the flows. To pick up on something that both of you said before, I think investors really need to realize that we have had a big regime shift just in the last 6 months. I mean, all of us who've been investing since 2009 have been accustomed to the zero interest rate policy. And what you did as an investor, you bought the dip in growth stocks. I mean, that was really the playbook for the last 10 years. And I think investors are still having, myself included by the way, are having a hard time with thinking that no, you don't just blindly buy the dip in all things growth because that's going to perform quite well. So that's why I think the repositioning that still needs to happen is we might want to broaden out what is it that we buy the dip in. And maybe not every growth stock deserves to be bought in this environment. So I think that's when we probably finally reach some sort of point of a washout, a capitulation, when investors finally realize that the environment that we're in is not one where stocks without yield can perform well, but it's stocks that have either a solid cash flow yield or a solid business model and are priced accordingly, they're likely to do well. So I think if we were to dissect through the flows, that's what I'd want to see first.
Yeah, great point. And John, you've written about this before. Is there a threat or is there a concern about over-diversification? When you're thinking about ways to rebuild right now, is there ways to spread yourself maybe too thin when you're trying to rebuild, reset your portfolio now?
Well, I've seen many cases of people, and they send me portfolios, and they've got 27 different mutual funds. And, that's a lot of securities, right? 27 funds, and some of those are even index funds, and it's kind of like combining different target date funds. I don't think there's necessarily a harm in that in the sense that when you do this, you're just ending up with sort of an index squared, and an index squared isn't a bad thing, just as an index not squared is not a bad thing. But it gets confusing to understand exactly how you're positioned as well as just tracking all that stuff. I think most people would benefit from pairing their portfolios rather than adding to them. But there's always the temptation. Look, we're up here talking about this, what to do now. Things change. Let's go add something. Well, maybe what to do now is actually to cut back on some things and simplify your lives a little bit.
I think that's such an important point.
Well, good. I'm glad I made an important point.
You make a lot of great points.
That's one in 45 minutes.
But personally speaking, as I was looking at my portfolio heading into the year, you load up on things that, I really liked, which is all things digital transformation and healthcare innovation and sustainability. Mm-hmm. And then, what worked in an environment of zero interest rate policy is likely not going to work going forward. So you want to take some risks, but you want those risks to be well calculated, and you really want to know what you own. So case in point, personally, I actually did pare back all these various individual stock exposures that I had. And I think that's probably what a lot of investors have done. And that's why there's not this sense of panic in the market right now, because people have de-risked the portfolios. And you're going to own your top semiconductor companies because you have a lot of faith in them. You're going to own your top biotech and healthcare companies. You're going to own some of the winners of the sustainability revolution. But you really, really want to know the companies or ETFs or mutual funds you own because, in the event of, another market downdraft, you don't want to be guessing what those companies are going to do. And you don't want to be guessing your value proposition for owning them.
Right, that expression, know what you own, so important, always important, but especially important right now. And it's those companies with cash flow, those companies that with reliable cash flow quarter after quarter that are not guessing or at the whim of the economy that might do a little bit better at a time like this. Christine, you know behavior very, very well. What are the worst mistakes investors can make at a time like now?
Well, John referenced the big one, which is chasing what has performed well in the very recent past. The good news is when we look at fund flow data, we are seeing a pretty placid pattern on the part of investors. Investors are leaving stock funds a little bit around the margins, but for the most part, when we look at what investors are doing, they're staying pretty inert, which turns out to be a good thing from the standpoint of their portfolios. We have seen some action out of bond funds, but I think the fact that more flows are being driven by target date funds, more investors are just turning their decision-making over to an automatic plan that does that rebalancing for them. I think financial advisors are driving more of the flows. We've been seeing sort of a counterintuitive pattern for a few years now, where from 2019 through 2021, for example, we saw really strong flows into international equity. And of course, international equity didn't outperform US during that period, but I think that rebalancing was going on behind the scenes. And to my view, that very much redounds to investors' benefit if they're outsourcing some of this decision making.
Yeah. If I can briefly just jump onto that point. I actually looked at this a little while back, flows into index funds. And for a while, there was just one index fund. It was the Vanguard 500 fund, and that was the only index for many years. And then we got more. The menu expanded, and we got the growth fund, and the value index fund, and the small cap fund, and the mid cap fund, and now we've got more as many index funds almost as there are stocks in the market. That's really not an exaggeration. And in the early days, when these index funds expanded, and you look at the flows into them, they were very much chasing the performance tail. So in the late 90s, a lot of money flowed into Vanguard Growth Index Fund as growth stocks were the new era. And growth stocks, it was kind of like, where we were recently, but 20 years back, with the internet stocks going way up and the value stocks just treading water, not making money. And then that reversed for 3 years from 2000 to 2002. And the flows were not, investors did not do well by that because they bought into the growth fund at the top and they didn't own the value fund. You see a lot less of that now. The index funds, even these little subsectors of the index funds, which could be tempting or lead one to buy this particular corner of that or that corner of the index. The flows are more stable, in my view, more responsible, and I think it's related to what Christine said. There are a lot more people using index funds and models and financial advisors using them strategically rather than as a tactical, rather than just as kind of a whim investment. I'll buy this, it looks like it's been successful, sort of a star manager type thing, but part of a strategic plan.
Right, there is this kind of battle, it's ongoing, active versus passive. Is now a time for good stock pickers, or is now a good time for just to let it ride on the good index funds? And we know a lot of investors, especially a lot of sort of 401k investors, they're passively invested, right? They're just buying the same mutual funds or ETFs every month that they set their accounts up with. Is that, in your opinion, I'd love to hear this from Morningstar and even from you, Anastasia, is that laying a safety net or a sort of support, imaginary support line underneath the stock market itself, just because there's so much passive money that goes to the same places every month no matter what happens?
Could be a contributing factor, I would think, and I have been thrilled to see the trend toward very low-cost index funds because John and we've been doing this for more than 30 years. Every time we run studies about what factors contribute to good fund performance, it comes back to costs. It's like Jack Bogle said.
Somewhere Jack Bogle is smiling right now.
The cost matter hypothesis. So it may be putting some artificial footing under stocks at least a little bit, but overall I think it's an incredibly healthy trend.
I wish it would put a stronger foot under the stock market. It's always tough to know what to do with flows because you looked at this year and the flows in funds have not been dramatic at all, and yet the stock market is down a lot. So somewhere somebody's selling and somebody's been getting out, and stock prices have shown that. But it's hard to see that in the flow numbers.
Sure.
But yes, I think clearly all things being equal, it's better to have this kind of passive, relatively passive, steady group like with the 401k monies that are coming in and supporting the marketplace. But there's a limit to what they can accomplish when interest rates rise as they do now and stocks are being repriced. Anastasia?
So to dissect that a little bit, who's been buying and who's been selling? Actually, somebody asked me a question earlier today. If you were told in the beginning of the year that rates were not going to rise by 325 basis point rate hike, which is what we were all expecting coming into the year, but we were going to finish the year at 4.5%, you would probably think the market was going to be down 30%. Right? And instead, the market is down 18, and that's kind of a good outcome.
Well, there you go. So
and
this is the good news.
I think part of the good news is that you have had this bid to equities from individual investors or institutional investors that are still deploying capital. And again, we see that in some of the ETF flows. I was surprised that equity ETF flows have actually still been positive for the year. U.S. equity ETF flows have been positive. So I think you have had this retail investor participation, the trader participation. But to dissect other parts of the market, you also had the corporate buyer. That's one of the largest buyers in the market. And by the way, the reason why we're having this very choppy September is because the corporate buyer is not in the market right now. They're in the blackout window, so they're not able to buy back their shares. But if you look at corporate buyback authorizations, they're at record levels, and they've been executing them as the equity markets pulled back. So I think between the individual investors stepping into ETFs, between the corporate buyers stepping in to do share buybacks, that's probably why, as bad of a year as we're having, it's not worse. And then on the flip side, you have a lot of other parts of the community, like hedge funds and commodity trading advisors, kind of the systematic managers that have been selling and have been contributing to volatility. But that's sort of the structure of the market, and I'm glad we have some of the longer-term investors that are stepping in.
It's ironic to hear the individual investor being portrayed as the helpful party in the market when for so many years, certainly I was talking about the late 90s, there were many articles that were, anybody wants to Google search, you can see that, about what's going to happen when the dumb fund investor hits the first bear market. Because it was the same sort of idea in the 90s, which was a long bull market. These people don't know what a bear market is like, and they're going to panic. And largely they didn't. There was some selling, a little more than now, but it was much better than it was anticipated. And I think the story people are realizing that now and realizing that actually individual investors, for the most part, I mean, we all know some people who maybe aren't entirely rational, but as a group, they're pretty rational.
But it's a really good point, because the presence of retail investors in the market have grown significantly, right? If it was maybe 10% of the trading volume a few years ago, it's at its peak, probably during the pandemic, has reached 30% of the volume, and it still is 20-25% today. So whereas before we used to look solely at hedge fund flows and seeing which way they're headed to kind of extrapolate where the market might be headed, I would almost argue that the retail investor presence is as important, if not more.
Yeah, and the game changed when the game changed a year and a half or so ago with GameStop and AMC and a lot of the meme stocks, which brought a lot of retail investors into the market. There was other reasons. There was, the pandemic, people were home. There was money coming in from the government. So a lot of that sort of drove that enthusiasm and that activity. But then there's been some studies recently, whether they're accurate or not, is that a lot of folks who got into the market are getting out of the market. But they came in for the casino and left when it stopped being a lot of fun, and are not sort of long-term investors who are in it for wealth building over time. But if you are in it for wealth building over time, Christine, you do such a great job of talking about different ways to allocate given your age and given your life stage. Let's just call out my life stage right now. In my 50s right now, pre-retirement, but coming off of a lot of years of good years in the stock market and thinking about continuing to wealth build over time. What do you recommend for folks, not necessarily the securities per se, but where should we be looking?
Well, first, Caleb, I love that you are talking about life stage, because it drives me crazy when I see talking heads on TV giving sort of blanket advice. It seems like at a minimum we should try to frame it by saying, based on this life stage, you should be thinking about this. So for folks in their 50s, I think it has been easy to be pretty complacent with equity risk. You've probably had a good experience with equities over your time horizon, notwithstanding this recent volatility. So for people who are nudging toward retirement over age 50, I think it probably is worth looking at de-risking the portfolio a little bit if you've been hands-off and if you haven't added to any fixed income investments. I would say hold your nose and potentially look at tiptoeing in there because yields are better, your return potential is at least a touch better, maybe not great on an inflation-adjusted basis, but the idea is that you want some stability in your portfolio so that as you get closer to retirement, it buys you some flexibility. If you decide you want to do a little bit of a pivot in your career or maybe go to part-time from full-time, it would give you that flexibility to draw upon your portfolio. You wouldn't risk having to draw upon an all-equity portfolio or mostly equity portfolio that was simultaneously dwindling. So for folks at that life stage, I do think a little bit of de-risking is probably in order.
Let's go down the age ladder a little bit. We got a lot of folks who are here in person and also listening, 20s and 30s. They're in that wealth building stage. They're in that long-term stage. They should be in the early parts of the marathon, so to speak. How aggressive should they be right now? How aggressive should they be thinking? We know the regime has changed. Anastasia, sort of outlined it pretty well, but we know the regime has changed. We're in a higher rate environment, right? A slower growth, higher rate environment, and we still have very high inflation. What should they be thinking about, even though that may be a different story a year from now?
I think they should be quite equity heavy, especially given that we have seen a little bit of an equity sell-off. The entry point for investors at that life stage is certainly much better than it was when things were feeling really good in 2021. So I think that they should resist the urge to hunker down in cash and not venture into equities with that nice long time horizon. They should be quite equity heavy. But I also think it's worth remembering that many people at that life stage have other goals besides retirement. They probably want to upsize their home, or maybe they want to pay for a wedding or kids' college. So you'd want to look at those goals separately, and certainly a lower risk portfolio might make sense for those specific goals.
Let's look outside the stock market. Anastasia, I know you look at a lot of intermarket analysis, looking at things that are happening with the dollar and what that's done to global equity markets. But if you're thinking outside of traditional capital markets or just on the fringes of it and alternatives, what's interesting now and what might do well in an environment like the one we're in?
Yeah. One of my favorite things to say in this environment has been buy things when it feels terrible to do so. And I think we can agree it feels pretty terrible.
Yeah, there's lots of opportunity now.
Yeah, it feels pretty terrible, but you know what? It probably feels less terrible than it did in June because we've reached the stage maybe in this bull market grieving process of acceptance. We now know we're in a soft landing, maybe heading into a recession. Rates are going to be at 4%. Anyway, the point is, as you look to buy things, whether it's in the equity markets or in alternatives, think about what the forward-looking returns may be from this starting point 2, 3, 5 years down the road. And so, for example, in the equity market, we did this chart where we looked at what happens if you historically invested from PE levels, price to earnings ratios, of 20 to 23 times. Well, guess what? Your forward-looking returns on a 1-year or 5-year annualized basis have been flat to negative because you've invested at pretty high multiples. And this is analysis we did going back to the 70s. And if you look at when you buy stocks from 16 to 19 times multiple or 13 to 16 times multiple, those buckets have generated positive double-digit returns historically. So I think that's pretty good precedent and part of the reason why we say buy things when it feels terrible and so when some of those multiples reprice. Now this applies to the public markets but also the private markets. One of the things that has happened is as public market valuations have gone through the roof, private market valuations, some of them have trended up higher as well. But what I expect to happen in the coming quarters, maybe in the coming year, is those private market valuations will have to start to reset as well. The reason they haven't yet is because a lot of capital has gone into funding companies at the tail end of 2021. So guess what? If you're a well-funded private company, you don't have to tap the market at the valuations, but at some point in the next few quarters, you'll likely have to. So when I look at investing in things like private equity and venture capital, you want to be deploying those dollars in downturn years. Because similar to that PE analysis that I talked about with the public markets, if you invest in the downturn years, your net IRRs, your net returns, historically would have been more positive than if you invested, let's say, in 2007. So I think that's a place to look at within alternatives. The other kind of tagline this year for me has been, get paid while you wait. While we wait out this choppiness, we wait out this volatility, And whether it's private real estate, well, let's say apartments, which we know what the apartment vacancies are like, that gives you close to 4% yield, depending on what you look at. Private credit gets you probably 9.6% yield. Most of that is floating rate. So I think there's a lot of ways to potentially enhance the income and increase your potential for returns with things like private equity, venture capital, et cetera.
Yeah, worth looking at for sure. John, is the U.S. the cleanest dirty shirt, so to speak, in the hamper, or is there opportunities outside the U.S.? A lot of economies are facing some difficult times. Emerging market economies don't like this type of economic environment with a really strong dollar right now and a potential downturn. Is it U.S. only right now? Because for a minute there, it did shift.
I'm actually leaning toward the reverse. I have been, I won't use the phrase America first, because that has a different connotation, but my own portfolio, in general, I write about U.S. equities. Generally my mindset has been that, I guess somewhat related to Jack Bogle. We talked about Chuck Bogle earlier, who famously or infamously, depending on your view, was kind of like, why not just buy only in the U.S., was his view. The markets tend to be correlated globally. You haven't had a lot of diversification in recent years from buying overseas, except for your performance being a little worse because earnings have not been quite as strong and investor enthusiasm not as much, as well as the dollar being strong. So there's been a confluence of events that certainly I've not been penalized for writing basically about U.S. equities and implying, if not directly stating, you might as well just own U.S. equities. I think this could actually be a turning point, despite some of the economic news not necessarily or looking unfavorable for some of these markets. And Europe is really pretty clearly entering into a slowdown. It's just between the combination of the weaker performance and lower multiples, which has been going on for a while, lower prices, and the strong dollar. The dollar will not continue to rise forever, or even maybe probably for a few more years. I think it's pretty close to peaking. It's probably a good time to be diversifying internationally. So I just said 20 minutes ago, I guess I'm slightly modifying my suggestion not to buy something new, maybe. But in this case, I'm actually thinking about buying some international securities, and I haven't really done much of that historically.
Yeah, and again, when people are fearful and when they think the worst is happening, the stock market is a future sort of timing mechanism. Maybe it's right, maybe it's not.
I've been reading arguments as to why international stocks are underappreciated for 15 years now, and I never took them very seriously, but now I am.
Well, it seems like the combination of valuation, higher dividend yields overseas, do argue for investors, at least who haven't revisited rebalancing of their U.S. versus non-U.S. exposure, to take a look at that, because it has been very easy to ignore non-U.S. I think you get
were
kind
never
of
penalized in the 2010s just for pretending that nothing existed outside of this country.
Right.
It was always a good thing.
Right.
Just like owning growth stocks.
That's right.
You didn't have to know value stocks existed. Yeah.
You get a little bit of a twofer with non-U.S. stocks, in that arguably value stocks are inexpensive still relative to growth, and non-U.S. markets do tend to be more leveraged to the value sectors. So I think you sort of get a double dose of undervaluation by looking at non-U.S.
Can I do a quick comment on that? Because I feel like I come down a little bit mixed on international investing, because it's really, really critical to know what, when, and why you buy something international. Because if you're buying something for higher beta, guess what? I can give you higher beta by looking within the U.S. equity market, maybe buying NASDAQ versus the S&P, or small cap versus large cap. So don't buy it just to get a higher beta, higher octane stuff. The other thing about international markets, it's fraught with currency risk, it's fraught with geopolitical risk, and that's really hard to manage for investors. And we can't always perfectly predict when the dollar's going to top out, or when it's going to surge or whatnot. But I like the idea of buying certain things in certain places in emerging markets for a couple of reasons. First of all, if there is a tactical change in momentum and macro momentum that can be identified, that is probably a good trade to be had in emerging markets. You can trade something very idiosyncratic, like the turnaround of Brazilian elections, for example. That's something that we've done before. You could potentially look at emerging markets today and say, well, they've raised rates a lot quicker, a lot faster than the developed market world has. So maybe they'll be quicker to cut. And so to your point, maybe now is the time to be looking at some of those economies. But guess what? You might also want to look at emerging market debt. because that's yielding about 11%, emerging market high yield. So that could actually be attractive and offer you equity-like returns with a big chunk of the coupon on top of it. So I think tactical trade if you have a shift in momentum. But the other way I would think about investing in emerging markets so that you don't just think about geopolitical and currency risk is, the secular trends, the mega trends that we talk about of digital transformation, healthcare innovation, and sustainability. Well, guess what? They're all playing out in emerging markets as well. And there's an Amazon in Chile, and there's I don't know. There's a fintech in, not that I should say this, in Russia, but you get my point. There's emerging market equivalents to the disruptors that we had in the U.S., and they're just getting started. They're earlier in their adoption stage, and so e-commerce may go from 3% to 15%, unlike it has already in the United States. So I like identifying some of these secular growth opportunities and that are earlier stage and putting the ideas together around that, whether it's in public markets or privates in EM.
Yeah, so follow Anastasia's research if you want to look into those. And I'm going to go down the line here, and then we're going to open it up to questions for a few minutes. But starting with you, Anastasia, what are the 2 or 3 things, indicators that you're going to be watching most closely from now until the end of the year that are going to give you the best sense of temperature shift and wind shift in what's going on in capital markets?
I think you're probably going to get the same one from all 3 of us, inflation. But I'll give you one specific measure of inflation that's really key to everything. It's the month-over-month change in inflation. The reason why I think the Fed is likely to be, technical term, freaked out by this last inflation report is the month-over-month figure for core inflation has moved higher than it was the prior month. It was 0.6, 0.7%. So instead of decelerating on a monthly basis, it's starting to accelerate. So what do you need to do in order to bring inflation down to 4, 3, 2%? You actually need to see very small changes in month-over-month and even declines to do that. And we're not currently seeing that. So that's what I'm going to be watching to hopefully see the change of the type of inflation, and therefore a Fed pivot, and therefore better outcome for the markets.
As you
Took the
said,
words right out of your mouth.
And not only that, but core inflation. I had a lot of people writing to me about energy prices earlier this year when they were soaring and complaining, and so it's this fault or that fault or whatever. But we've seen recently energy prices have come down a lot, and the market got absolutely hammered because it didn't care with the latest inflation reports looking at core inflation, stripping out energy. Yeah, energy dropped 10% in a month, but guess what? That's not the major concern. The concern is the core inflation, the shelter and transportation and other costs. Well, transportation wasn't so bad because of inflation. Shelter in particular is a big one. And when the Fed's seeing that, it's just going to keep raising those rates, and it's not going to stop until that decelerates. And
John, then we get into this thing where the 30-year is over 6%, so it's driving would-be first-time home buyers into the rental market, which is driving rental prices higher. So it's kind of like this snowballing effect where
eventually the rate cuts will have their effect of slowing down
demand destruction.
Demand destruction. It's a question of how destructive it is, right? And so there's certainly room for the markets to drop further. And core inflation, I think, is absolutely the key figure. So your prediction is spot on of what we were going to say.
Inflation.
One related issue, speaking of mortgage rates, is just, I think it could lead to kind of a state of stasis in the housing market, where if you have a mortgage interest rate of 3% or 3.5%, you're not going anywhere, right, with mortgage interest rates 6%. So I would pay attention to that housing sector. We saw before that it's a big driver of what's going on in our economy, and I do think that there are a lot of homeowners who probably will be sitting still given the current interest rate regime.
Yeah, the housing sector is going to be, I think, the big story the second half of the year as opposed to energy in the first half of the year. Gas prices.
In that you think it...
I think it is really going to start to slow down. There's going to be a slowdown in the hits on housing prices. Yeah, at least in the, as you say, rental maybe not.
Yeah.
And the disjunction between the two and just what happens there. It could decelerate quite quickly.
Yeah, we'll see if that happens.
Yeah, we'll see.
Do we have questions from the crowd? Anyone? We have a mic going around here. I think we're going to fire up the mics here, so feel free to ask questions yourselves. I know we have some coming through online.
Does this work? Oh, hello, everyone. Yes, we have questions online. First one from Douglas. Currently, what % of the equity market is represented by the retail investor?
Good question. Morningstar, can you guys tackle that?
What percentage?
What percentage of the U.S. equity market is represented by the retail investor?
Well, they're about, to my knowledge, I'm trying to remember, I think about 15 trillion in domestic equity funds, and well, it was 50 trillion. It's come down a little bit. The value of the U.S. market, so maybe 40%.
Yeah, that's what I've heard. Somewhere between 40 and 50%, but that waxes and wanes.
That's a back of the envelope number. If I had my trusty computer here, it would not be back of the envelope, but.
Yeah, and I guess there's maybe, twofold question there. What % of the assets that are invested in the U.S. equity market that are held, let's say long-term assets that are held by retail investor, and that's the answer. But then there's the trading flow, and that's the number I was referring to before. Before, the retail investor was not a huge participant in day-to-day trading because their commissions involved were quite steep. But to your point, Caleb, when the tide shifts and when the circumstances change and when Schwab and Fidelity and everybody else goes to zero commissions, that's what's really unlocked, the presence of retail investor in the day-to-day trading. And that's why those volumes went from maybe being 5 to 10% of the overall trading flow to being 25 to 30% at the height of the pandemic.
And I should modify my answer. Now that I thought of it more, those are the overall fund amounts, but some of those are institutional monies. There's, of course, money people have in equities outside of funds as well. The better number actually is to look, the Federal Reserve has these numbers of household assets versus others, and that's where to go for them. So,
the Z1.
Put a big asterisk around my
Z1,
answer.
you're absolutely right.
Yeah, Z1.
Another one?
We have another one from an online attendee. Is it wise to simply take a break from investing if the market is bad and you're not willing to take extreme risks?
Yeah, I'm going to handle that first, but I definitely want to hear from the experts. A decision to not do anything is still a decision, and for retail investors, individual investors, us, a lot of the folks online, you don't have to do anything. This is not your job. You cannot put money to work. But to continually invest, whether it's passively through your 401k or through your SEP account, month after month, it's never really been a bad idea, even in bad markets, because you can dollar cost average in. But the decision to do nothing is also a reasonable decision, right?
Absolutely. But I do think that most investors should put this stuff on autopilot. Just set up your dollar cost averaging plan in line with whatever you think you can spare. And of course, inflation makes saving a little bit more difficult. But set it up, remove the emotional element from the equation. Just make those contributions on an ongoing basis. That's the way to do it.
Yeah, we say pay yourself first and make sure when you're paying yourself, you're saving some, investing some, so if you can, do.
I assume the question, take a break from investing, didn't mean pull my money out and put it into cash. That's a break from investing. That would, I think, pretty clearly be unwise. History of market timers is not a good one. But if it's take a break from investing, meaning I'm really not having any fun making these trades anymore because whatever I buy goes down, yeah, fine, you can take a break from investing that way. Whatever you hold may go down, but it's at least,
Unless you're a
at least you're not doing damage to yourself in the same way as pulling out and going
you're not
to
a
cash.
professional money manager. You're not being judged against the S&P
That's exactly.
500. So do what feels comfortable to you. Any thoughts on that?
Yeah, just real quick. I mean, I think that's right. A lot of people probably have already taken a break from kind of the day-to-day trading. But look, again, earlier this year, we wrote this Outlook report and said in order to beat inflation, which at the time we're expecting to be 4%, you kind of had to do something, right? And that's why we looked to a set of alternative asset classes where you can get 4 or 5 or maybe even 9% yield. Today, to not invest in anything at all, I don't think it's really a great option either because inflation is still 8.5%. Right? So if your portfolio is sitting in cash, which for now is still yielding 2.5%, and inflation is 8.5%, you're still losing value in real terms. Now, cash is probably going to go to 4.5%, before too long, so that's better. But again, there's things you can do that are investing in different cash alternatives or in different part of fixed income instruments that can improve your yield on cash, which I think is very important to offset the inflationary impacts that we have. And then, second point I would make is, yes, maybe it's okay to take a break from day-to-day trading or trade this big range that we now have. But again, when we look 2 years or 3 years down the road, I hope we're on the other side of 8.5% inflation, right? And then you will have said, well, it would have been nice to buy into some of the favored opportunities at those cheaper valuations. So maybe break from trading, but I would say now is the time to think strategically of what trades you want to make or investments you want to make for the next 2 or 3 years.
Right. And when Anastasia talks about alternative investments or fixed income or other ways to access the capital markets, it sounds intimidating for a lot of individual investors who don't have a lot of experience with that. But guess what? There's an ETF for that probably. There's an index fund for that probably. You do such a great job of giving people a variety of ways to choose from it. Morningstar has great tools if you're looking to screen things into your portfolio that might fit your objectives. So there are ways to access this for retail investors that didn't exist 5, 10 years ago, and those are all worth looking at. So
Yeah, we have 30,000 U.S. funds in our database, and those aren't multiple share classes. Those are 30,000 individual funds
And
between
your
mutual
team
funds
does
and
the work on
ETFs.
rating those, and
There are a lot of options out there.
plenty of things to choose from. Anything else from the crowd?
There is one more. I think we
We'll
have enough
take
time.
one more. We got 2 minutes. We'll do it quick.
This is from Allison. Where should someone start investing during this time as a beginner?
As a beginner, let's assume Allison, if she's a beginner, maybe on the younger side. I'm just going to make that generalization right now. Christine, where do you direct?
Assuming that it's for retirement, I would say homing in on the goal would be the first step. But assuming we're talking retirement funds, hard to go wrong with a target date fund, which would be 90% equity for someone in their 20s and 30s. Does a really nice job of managing that glide path as someone gets close to retirement. When we look at investor behavior, the category that wins hands down is the target date group. Investors just tend to set it and forget it, and it turns out that that's a terrific recipe for success as an investor.
It's the forgetting it that's so hard, but that's the whole point. John, do you have a thought on that?
I mean, target date funds are fine. People don't buy target date funds outside of their 401k. It's funny, they're very happy to own them in their 401k, and outside their 401k, they tend never to buy them. And if it's for retirement, it's for the same purpose. So it's just it's a bit of a quirk.
What would you tell your 22-year-old self?
Well, first of all, I own a target date fund in my IRA, so I guess somebody does buy it outside of the 401ks. You know, my initial response.
Well, there you go.
Yeah, my initial response was going to be, well, you want to have a barbell strategy of some dividend-paying stocks with some of the, the secular growers, like the software, and maybe sprinkle a little bit fixed income. But then that's a target date fund. That actually ends up being a target date fund, and which is mixed up in the right allocation for the age and that target retirement age. So I think that's a great place to start.
And a very last thing I'll add is, because I've looked specifically at this, target date funds do come in for a lot of criticism because they're very visible funds and a lot of people have them. But if you compare the performance of target date funds to like other kinds of balanced funds or allocation funds, they're perfectly competitive. So if you ever read an article saying this is why target date funds are particularly not as good as other kinds of funds, I'm saying don't buy it. Don't buy the argument. You can buy the target date fund.
Yeah. Great stuff, great analysis, great insights. Thank you so much. Christine Benz, John Rekenthaler, Anastasia Amoroso.
Thank you.
I follow these folks. I read their research. I'm constantly learning from them, so follow them. See what they're up to, and you guys have a terrific podcast. You're constantly on the air on CNBC and other places, and a great blog. Thank you so much for being here and kicking off our investor connection with Morningstar. Thanks so much.
Thank you.